Hi guys, in this video we're going to be talking about derivatives. Traders often say derivatives are the eighth wonder of the world, and I completely agree with them. National Stock Exchange permitted trading of derivatives on exchange in June 2000, and yet after 21 years of their existence, very limited people know about it. So let's change that. Let me tell you something interesting about derivatives. Through derivatives, you can speculate, or people often say bet, on almost anything. You can even bet on the weather tomorrow, and if it turns out to be sunny, voila, you made a good money. A derivative is a contract between two parties that derive its value slash price from an underlying asset, interest rates, as I said before, weather, or any other thing. Let me give you an example. Suppose you and I enter into a contract in which I will sell you 3 units of Reliance shares for X price after Y days. Now your profit depends upon the price of Reliance on the Y date. Suppose the price of Reliance is more than X. Then you will make a profit because you will purchase share of Reliance from me at a lower price and may even sell it on the same day at higher price. But if the price of Reliance is lower than X, then you will make a loss because you will have to purchase the same shares from me at a higher price than the price at which it is available in the market. Now, this is a contract. You cannot back out of a derivative contract unless it's an option. We'll discuss about it in a few minutes. Now, let's understand different types of derivatives. First of all, futures. Futures are an agreement between two parties for the purchase and delivery of an asset at an agreed upon price at a future date. As I gave you the example before, they are traded on stock exchange such as National Stock Exchange and Bombay Stock Exchange and are subject to strict regulation. Forward contract are similar to futures but they do not trade on exchange, only over the counter. For example, if you and I enter into a contract to buy or sell a bond on a future date directly, it will be considered as a forward contract. But if we enter into a contract through National Stock Exchange, it will be considered to be a future contract. Swaps. Swaps are another common type of derivatives often used to exchange one kind of cash flow with another. Let's understand with the example. Suppose you and I enter into a contract in which every month you will pay me a fixed interest rate of say 7% on 10,000 and I will pay you a variable interest rate of fixed deposit as prevailing. Options. An option contract is a similar to future contract in that it is an agreement between two parties to buy or sell an asset up at a predetermined future date for a specific price. The key difference between an option and a future is that with an option, the buyer is not obliged to exercise their agreement to buy or sell. It is an opportunity only, not an obligation. Futures are an obligation. Let's understand the terminologies associated with options. Put options. It allows you to sell a security at a particular price on a future date. Again, you don't need to sell. You can sell if you expect any profit and not if you expect loss through selling. Let's take an example. Suppose you have 10 shares of XYZ company and the current price of XYZ shares is 100 rupees and you expect the price to increase to 120 rupees but you don't want to take the risk of downward movement. Then you can buy a put option to sell securities at 100. So if on the future date the price of securities reduced to 60 rupees, you will still be able to sell securities at 100 rupees. And if the price increases to 120 rupees, you will not exercise the put option and will sell the securities in the market for 120 rupees.